Hi, Sean Kidney, back again. What a day we've had. It's been a very full day of issues and discussions, at least from my perspective. Starting off with an interview with Martin McGuinness, the European Commission's Commissioner for Finance, Financial Stability, Capital Markets Union. Moving into a range of other sessions. I'll cover them in a minute. But today, we end with a session looking at the global roundup and looking at the implications for the market. I've taken my jacket off because now it's time to get down to work instead of talking ideas. We now need to start thinking about what the implications are for the market, what the trends are likely to be around all these sort of issues, and I've got some friends joining me. I've got a couple of housekeeping issues I've got to do first. Our sponsors. JP Morgan is our global sponsor and our sponsor for the Global Day, which is what this is. But as ever, I need to remind you, we exist because of the sponsors who are able to fund our work. We only work for sponsors who are working for change. Let me be clear about that. All of these organisations are committing to do something. It doesn't mean they're clean skins. I mean, they're doing work for the brown or the dark side at different times. That's the nature of change. We're transitioning our organisations, transitioning our countries. Every country in the world, every major economy in the world has got a dark side and a bright side. Our job as activists, as committed people thinking about the future for our children, is to help those organisations and those countries and those governments change. These organisations are committing to change, are saying we want to change and help their clients change, and that's why we're proud to work with them. Of course, there's a couple of housekeeping events. Don't forget the Q&A box. Please ask questions if you can. There's interpretations. Look for the headphone icon. Lots of interpretations. And of course, all the sessions are being recorded and the cool tools on offer in the networking. Let me go to our panelists. We've got a few friends. Namita Vikas is a senior advisor at Climate Bonds Initiative, which she does pro bono, by the way, because she's got a daytime job at Octus ESG, based in India, doing global advisory around ESG. Look, to be honest, Namita's claim to fame in my world is she launched India's first green bond and got that market going, which was an important milestone. We've also got Rupert Rink, who is an ESG analyst at our Global Day sponsor, JP Morgan. And have a look at the interview of Chuka Amuna if you want to see what's really going on there, because we had a really good conversation. There's some fantastic things happening. Anna-Marie Slot, who's the Global Environmental, Social and Governance Partner at Ashurst LLP. Now, shouldn't every single law firm have a partner like that? That's not what she was. She pushed, she changed, she's an activist, and she got agreement of the partners to set up this, and she's growing a practice in this area. That's absolutely what we want to see in all organisations. Agnes Gourc, who's the co-head of Sustainable Finance Markets at BNP Paribas Asset Management, also a sponsor, as is Ashurst. And then Michael Ferguson, Senior Director and Analytical Manager for North America Sustainable Finance at S&P, used to be Standard & Poor's Global Ratings. Thanks for joining us, folks. Let's see if I can get your faces up on screen. How are you all? I hope you're well. I hope you've had a chance to catch some of today's sessions. We've had a pretty crazy day going forward. I'm going to ask you for some initial thoughts, reflections, and then I might pick up a few specifics of the sessions, talk about resilience, talk about, the session that was most important to me today was the Green Windows session. Well, they're all important, but I want to look forward about how we can achieve change really quickly, because we've got to move really quickly. And that means not only government change, but of course the role of investors and the role of financial institutions in achieving that change. In the Green Windows session we had a while ago, there was a discussion about that, but there was quite a lot on today. This isn't about unpicking the sessions. This is about your reflections on implications for the market, where we're going, what do you see happening in the next 6 months, 12 months, and maybe things we've got to do. I'm going to ask Rupert to kick us off, actually, if I might, to get the ball rolling. Your thoughts?
Thank you, Sean. I think before I touch on my reflections of the fantastic day that we've had, I think it's important to reiterate Mark Batriciani's opening address this morning and reinstate JP Morgan's proud sponsorship of this year's Climate Bonds Conference and working in partnership with CBI as we as a bank aim to promote the global capital markets to prioritize the needed sustainable development to transition towards a net zero world. And I think one of the things I picked up from what Mark said is that we all have a role to play in helping this transition towards a sustainable global economy. And I couldn't agree more. And with being part of a global investment bank like JP Morgan and arguably unraveled reach across global financial markets, JP Morgan must play a central role in promoting that coordinated climate change transition response. And as you know, Sean, CBI is quite central to that. So at least I think I need to first touch on that, on Mark's first words. But if I were to reflect on some of the interesting discussions I heard today, it would certainly have to do with the discussions with Mary McGuinness, John Morton, and also Sean Chang. Because I think if you couple their narratives together, it's actually a very powerful message. So while Mary touched on the global sustainable finance work that she's doing within the European Commission, which is absolutely leading the global agenda with their ambitious 55% emissions reductions by 2030 and, of course, mid-century net zero. And this is via the EU taxonomy being the centerpiece science-based tool to ensure that European capital is indeed coordinated in such an credible and to achieve these ambitious targets. But then she made this really important point that it's not enough and that the rest of the world needs to come to the table as well. And how relatively Europe actually contributes only a relatively small portion of the global summer greenhouse gas emissions. And so I agree with the point that we need to have a common ground taxonomy that everyone can base their work upon. So coupling that message with then John Morton's comments about what he's doing in the US Treasury and his point about how the current US administration is arguably prioritizing climate change beyond any other administration in the past was really powerful. And the biggest takeaway I took from his discussion with you, Sean, was this big announcement that's coming in later October, how the US Financial Stability Oversight Council report is looking to set a suite of recommendations to President Biden on climate change data disclosure and financial risk. In other words, it's going to send a clear message to the US financial market on how they ought to prioritize their sustainable finance agenda. But while this is not only happening in the US market, then this is coupled with your conversation with Sean Chang, who equally mentioned how in the Chinese market, there's a picking up of pace of the China's own sustainable taxonomy over the last 12 months. So upon reflection, it seems as though these major economies, the US and also the Asian markets, are somewhat in a position near the end of 2017 for Europe, just before the EU launched the EU Action Plan on Finance and Sustainable Growth, which essentially was this comprehensive blueprint to mobilize the entire European market to achieve this transition to a sustainable economy. This was within 10 initiatives, the EU taxonomy being central to that. And so it certainly gave me a lot of, you could say, enthusiasm and optimism for the future that these powerhouse markets are following in the lockstep, you could say, footsteps of Europe. And perhaps later it'll be really interesting to touch on one of the other initiatives within the EU Action Plan, which is the development of labeled sustainable benchmarks, which is critical to the work I do within JP Morgan.
Great point, Rupert. And yes, Mark's comments were very good this morning, I have to say. Agnes, of course, BNP Paribas has been a leader for some time, but it is great to now see a thundering herd of banks getting involved, getting aggressive around climate change. That's, I think, the big change in the last 5 or 6 years. You've been, I'm going to say, using the word beavering away at this for a long time now. What are your thoughts and reflections after today?
Thank you very much, Sean, and very glad to join the panel. And Rupert had made a great summary of the day. So what I would say is effectively, you're right, at BNP Paribas, it's been really a key focus for over 10 years. And it reminds me a little bit of, some of the earlier Climate Bonds Initiative conferences where you'd been hammering down the message, things need to change. We have to do things more quickly. And that's really the message we've been putting forward for a long time. And the spirit really of it has always been, how do we accompany our client to do that shift? Because those are really significant shifts that we are looking at. The real excitement of the last few months, I would say, is, for a long time, even after Paris Agreement, you could have argued, are we really going to get there? I think for me, a big change is all the UN convened zero alliances. And that, I think, in the last few months has been a big step forward, because effectively we are continuing hammering the target, in more and more details, and then closer and closer. And obviously the theme of the day, 2030 target, is quite clear about this. And once you have these really specific commitments within what we call intermediary target in our language, there is no way backward. There is no turnaround. And that's really, I think, yourselves, all the participants on this roundtable, and very much, inside our bank, has always been the question, how do we make sure that actually change is going to happen? And how do we make sure our clients have the financing tools available to do that? So that's really, I think, I think we can all be a lot more hopeful today, I would say, than even 12 months ago. And we've seen it happening across sectors. You take, key sectors of our economy, such as oil and gas, they have now come to the sustainable finance market and have shown that they are really leading the way as well in their transformation. You look at all the European majors, they have put significant strategies forward to show what they are doing in that respect. So I think this is really positive. And I like to say that actually, I do believe now ESG is unidirectional, and there is only one way. And even if a couple of years ago, some sectors thought they were maybe still removed from the discussion, I don't think you can find any sector, any treasury team even today that can tell you this is not the case and ESG is not at the forefront of their mind. And we do ask our clients very frequently, what are the key elements you put on your priority list that may be the headwinds in the future? And across sectors today, really ESG is coming back. So, it will be things like interest rate and so on. And then ESG will be also part of the discussion. So that's, again, really key, because you didn't have that even a couple of years ago. You had it in some sectors, but definitely not everywhere. And then the next question is, talking a bit about the sectors, but also indeed across geographies, what is going to happen? Clearly, and a lot of us today are kind of calling in from Europe or London, there is a lot that is going to happen with the suite of measures that are being put in place by the EU Commission. And I think, you can always kind of then see, to what degree, at what speed this will happen. But at least it gives a clear, common language, at least, be it EU taxonomy that will define what are the projects that, we are looking at defining as green, be it SFDR that will tell you, okay, the common language is we would expect this and this disclosure for a given fund. And as we've seen in recent weeks, obviously making sure for asset managers that, they do clearly explicit what they are selling as ESG will be really key. And this will, we know there are heavy discussions, and Rupert kind of highlighted in the US. I think we can be quite hopeful as well that, it will be very visible in the coming years with the measures that are being implemented already in Europe, but, US probably not too long following. And we know in APAC a lot has been happening, and discussion on with the EU have been very intensive as well. So I think, I would say I agree with Rupert. We can be very hopeful from that perspective.
Well, that's pretty exciting, isn't it, everyone? Very hopeful. Two people saying this now, and God knows we need hope at the moment, given the challenges we're beginning to face. But it is true. Anna-Marie. You've been growing a practice. I'm hoping you're going to tell us that your practice has been incredibly successful because so many clients are coming up and saying, yes, it's time, I want to act. But that's not the only thing I want. I want your thoughts on what today means and what implications are for the market.
Thanks, Sean. No, actually, I mean, you laugh about it and you make a joke, but our clients are increasingly asking us about this, and there is huge movement from 18 months ago, where I had to explain to people what the E, the S, and the G stood for, to now we routinely are engaging with clients on not only their challenges, but also the entire supply chain and how the different components of that work, and how this is a problem that is an integrated solution and not a standalone solution. One person doing it on their own or one company doing it on their own doesn't really have an impact. But when you look at the entire economic system, you start seeing where you can really make big changes. The day was very interesting. I even as a lawyer, I think I probably echo the hopefulness. I know that's a bit strange coming from a lawyer, but the thing that I thought was really fascinating and really kind of pulled it all together was one of the comments that Paul Budnar made, where he said, we are in the midst of trying to remake the physical asset base of the global economy at scale and at speed, at a speed that's never been seen before. And I think it's that really puts into context, I think, what everybody here has been trying to achieve. And it shows you the size of what we're doing. But I think, to my mind, that also shows you the opportunities that are intrinsic in it, and how, when all of these different UN groups and corporates and investors get together and focus on, what that externality looks like and how we adjust to it. I'm quite interested to see what happens and to see how we work with our clients on that innovation and that transformation that everyone is going to have to go for in the next 10 years. And that's also the other key that I think is really interesting. Everyone is now talking at a 2030 number. People have a 2050 aspiration out there, but the people who are really kind of shifting the dial on it's a 2030 goal with a 2023 deliverable and a 2025 deliverable and a 2028 deliverable. And it's those landmarks, those points in the sand that really, boards are focused on. What are we delivering in the next 10 years? Investors are focused on, what's my investment going to look like in 7 years when I want to roll out of it? And companies are looking at it. How is my investment into this project going to look like in 7 years if it's regulated to such an extent that I actually can't operate it? It's a really fascinating intersection right now. And I think the conference in particular gives people so many tools that they can take back to their own organizations and look at, what are we doing today that furthers what everyone's talking about on the panels. That'd be my takeaway.
Good point about the 2030 targets. I mean, we do have, which is a critical thing of the day, we have all the biggest economies of the world, bar one, committing to some form of aggressive 2030 target. Namita, rumour has it that Prime Minister Modi is planning to come to the COP with a 2047 carbon neutral target. Why 2047? 100 years since Indian independence from the crazy madness of what used to be called the British Empire. The British, well, we won't go into pros and cons of empires there for a minute, but you know what I mean. And I think the truth is that the agenda in emerging markets has grown quite fast. Doesn't look at the green hydrogen strategy that's been announced by India, but also the green hydrogen developments in Saudi, where tomorrow we've got Paddy Papanathan from the Saudi energy company Aqua talking about those changes. I mean, this isn't just a rich world phenomena, isn't it? What do you think the implications are of what we talked about today and all of this in terms of, look, what we care about is growth of green instruments and opportunities to invest?
Thank you. Thanks, Sean. And I think Sessions were interesting, insightful, and I think extremely important, like the other colleagues here have mentioned. And I think it was inspirational from a standpoint that it served as a food for thought on compelling, potent opportunities that green bonds or this whole new area has posed, especially for emerging markets after the devastating impacts of the pandemic. And my take on today, I have 1 point and 2 examples to make. So the point is that rebooting of emerging economies following the pandemic has already begun. And within this sits a $10 trillion opportunity for green investments across 21 major emerging economies that was surveyed. This is a Ramundi IFC survey that I was looking at. And these investments are slated to support job creation, lowering carbon emissions, and delivering on significant sustainable growth, which is much required. So these countries represent 62% of the total, the world's population, and 48% of emissions. Therefore, investment opportunities are ripe for the taking and would propel these economies in the race to net zero. But the question is, how can the global green investment, bond issuers, green investment market take advantage and accelerate towards net zero? Because these are the goalposts that we are looking at, and where are the opportunities? So take India, for example. Climate action is indeed heating up. Recently, UK announced a $1.2 billion package for public and private investments in green projects and renewable energy. On the other side, the Indian Railways, who you know very well, Sean, announced its net zero targets by 2030, making it the largest green railways in the world. Electrifying railway tracks through renewable energy has gained momentum and increased by nearly 10x since 2014, with all balanced broad gauge routes to be completed electrified by the end of the year, that's December 2023. It is also working towards installing 20 gigawatts of solar for trains and about over 7,000 railway stations and offices. And it has already installed rooftop solar in hundreds of railway stations across the country. Now, both these projects, the remaining electrification and the net zero targets that they are putting out, serve as a huge opportunity. Indian Railways is no stranger to green bond issuances, having issued one of the bonds of $500 million USD in 2017. On the other hand, green bond investors are also familiar with such products, given the similar investments that have been made by financial institutions so far in the past. So ADB's investment in Georgia Railway, so on and so forth. This builds the confidence, and therefore minutely screening net zero ambitions of countries and going after these would serve as a new investing universe and increase the uptake of green capital through these kind of issuances, also enhancing the capital raising pie. So that's my first example. My second example is, look at the opportunities that are sitting within the small islands developing states. Airports and SIDs remain heavily reliant on diesel generation for electrification. Grid-tied solar electrification through mini grids to these airports of the small islands would help diversify local power grid, reduce carbon emissions, and enhance the SID's resilience in the face of future extreme events. Now, leveraging innovative finance mechanisms like emissions trading systems, green or transition bonds, and climate funds to pay for necessary infrastructure upgrades and initiatives is the key. So financing climate resilience can be challenging, of course. However, creating blended finance structures with capital flowing from, say, OECD countries and other public and private sources for SIDs through maybe net zero resilience bond issuances backed by securitization would certainly attract mainstream investors and new class of investors and bring in the necessary capital inflows to SIDs. Now, such interventions would not only unlock significant reduction in emissions and accelerate the net zero targets of SIDs, but most importantly, a financing mechanism that can create a template to replicate and scale across 52 small island developing states as a cascading effect that provides the right investment environment and market. So that's the opportunity, or those are the kind of opportunities that we are looking at. And it is for, the investors to go behind these opportunities in a very targeted manner to be able to capitalize on them. Thanks.
There's a lot of opportunity, isn't there? It's very interesting your point about Indian Railways and rooftop solar, an extraordinary rollout of rooftop solar. I mean, where's the rooftop solar, Michael, across railway stations in the US? Why haven't we started doing this? Of course, under Biden's infrastructure plan, we do expect to see a huge mountain of infrastructure investments. And John Morton said in his interview that they were looking to how the US government would be a leader in investment, not the only investor. That is, creating opportunities for private capital as part of it. So that's one very interesting point. And we've also seen some price movement in the green bonds that are coming off the back of these. In fact, we see this understanding by investors, and Rupert might want to comment about this later too, about lower risk of green bonds, and there's lower volatility now. And Rathan Roy made the comment earlier on, green bonds have lower volatility than other bonds and are therefore being seen as premium products. Oh, it just looks like a lot's going to happen in the US. What's your reading? Tell us your thinking.
Yeah, gladly. So I should say to all of you that I'm sitting here in New York right now, and I was planning on talking about the IPCC report until about last week. And then last week here in New York, we got hit with a torrential downpour, the likes of which I've never seen, and I've lived in this area for almost all of my life. And so it just articulates the need for further investment in resilience in the United States. I think it's fair to say that there has been a significant underinvestment during the past 40 years in the energy, utility, and transportation infrastructure throughout the United States. And the Biden infrastructure plan that Sean alluded to there actually speaks to a lot of those things. So there's significant investments in transmission. This was a major issue with the Texas storms that we saw about 6 months ago, that the transmission system was not well suited to deal with the fact that the generation within Texas was shut down due to a variety of operational and weather-related reasons. Fire resistance is obviously a major thing. The West Coast of the United States has been facing a seemingly perpetual heat wave and fire season, and it's only getting worse with time. I think this month may be the worst fire month in the history of the United States. And obviously roads and bridges. When we look at the allocation from the Biden infrastructure plan, it looks like it is focused heavily on rebuilding roads and bridges. For a lot of reasons, they are antiquated, but even more than that, they're antiquated when you consider that a lot of them are adjacent to the sea, which means that they're going to be very exposed to rising sea levels. So I think the Biden infrastructure plan, at least the one that's already passed through the Senate, is highly consequential in solving some of the resilience issues that the country faces. The bigger challenge, of course, is the energy transition, which is not really addressed to a great degree in the Biden plan that has already passed. It is being addressed in the what we call budget reconciliation, that is a lot more partisan, doesn't necessarily have a ton of Republican support for the moment, and is a bit controversial for that reason, but it is every bit as essential to mitigating the risks associated with climate. The United States, I think it's fair to say, in the last couple of months, has gone from being a complete laggard on climate, at least at the federal level, to being in a position to really kind of assert some leadership. And certainly I think the passage of these two bills would go a long way towards cementing that. But to go further than that, I would say that one of the things we heard earlier today was discussion about the SEC and some of the rules that are being put in place. I'd say those rules are not final yet. Obviously, the SEC is doing a lot of research with investors, I should say, to figure out what the disclosure requirements should be around climate. It's still early in that process, but that's important, and it's important for a variety of reasons. At S&P Ratings, we're in this really privileged position where we get to speak to issuers and investors alike. And right now, there's information asymmetry. It's something that investors complain to us all the time about. In fact, we talk to a bunch of them, and a lot of them talk about lack of comparability on climate metrics. They talk about lack of access, lack of uniformity. They refer to not trusting the information because it's not audited in the same way the financial information is. And that's worrisome. We can play a role, obviously, in mitigating concerns around greenwashing, concerns around lack of disclosure. But at the same time, the SEC could play a much more forceful role in doing that. I think it's fair to say that if we want capital to flow in an efficient, fashion to projects that are the most sustainable and that are going to be the most effective in creating resilience and transition solutions. There just has to be harmonization of information that investors who understand this as a growing, burgeoning risk can accurately and regularly compare projects on their environmental merits, not just their financial merits, because that's an important piece of all this. A lot of the reason why the infrastructure in the United States is underfunded is because a lot of it is curious to long-term investors. A lot of them are actually concerned about investing in a 30 or 40-year, let's say, road or bridge project when they don't know whether it's climate resilient or not. It's a challenging enough question as it is to invest in a long-term project, especially with interest rates being so low right now, where the return is not all that significant from investing in it. And so it's our ambition to be involved in this. S&P Ratings has developed products recently to help overcome some of the concerns around greenwashing in the market and to ensure that there is a high level of uniformity and comparability in green and social issuances. And there's more to come on that over time, but I think certainly a good first step is for investors to kind of continue to answer these questions, continue to kind of work with issuers and put pressure on them in order to require metrics that are going to be helpful for them in making their capital allocation decisions. Regulation is great. Obviously, the SEC will do more on that, but that's slower. And certainly what can happen more quickly is investors becoming more knowledgeable, more savvy on this themselves. And I think that where the capital goes, so will go some of the reporting. And I'm excited to see what it looks like.
It's been a pretty incredible week in New York, that's for sure. And hearing a president come out and say this is a climate change incident was like a defining moment in American politics, I thought.
Oh, sure, it was.
It was pretty amazing, and of course it was. We've been experiencing those all around the world. We still have mad wildfires across Siberia, of all places, melting the permafrost. If anything you can say about this year, this is the year the climate change impact started becoming very, very real. But it's interesting what you say about standards, because of course that's what Agnes was talking about too, and what John Morton was talking about. And we've had a lot of people in the last few days talk about these too. Michael and Rupert, in the US market, do you think that this the taxonomy work that we've been doing in Europe, and Agnes's colleagues at BNP Paribas have been actually involved in the technical expert groups and so on around that, is going to move across the US, or do you think the US will do its own thing? What's your reading about this, particularly the international comparability question, which is worrying a lot of investors, that each nation does its own version? Does that make things actually harder rather than easier? What's your reading? Maybe Michael first and then Rupert.
Sure. So I was actually, before I did this, I was actually a CPA for a number of years, and I was actually a CPA when we were talking about the harmonization of IFRS and GAAP reporting standards on the financial side, and I remember how well that went, and so I guess I'm not totally optimistic that it would be easy for an EU taxonomy to transition in the United States without a lot of opposition. That being said, I certainly think that the SEC has shown a real willingness to listen to outside solutions in a way that they probably didn't during the prior 4 years, and obviously the EU taxonomy is gaining traction in part because so many of the the large banks, especially that we work with, a couple that are represented here, are espousing it, are taking it seriously, and have operations in the U.S. and obviously in Europe as well. So I do think that it's in general, I would say it's good governance for companies to kind of follow the most stringent regulations that they face globally, and increasingly a lot of the companies that we look at are global companies. So I don't know that it'll necessarily translate into the EU taxonomy being adopted verbatim in the United States, but I do think that there's some sentiment that the U.S.'s economy is very exposed to climate risk, not just from a resilience perspective, but from a transition perspective, with significant investments in oil and gas and metals and mining, of course. So to be determined, it seems. I'd be interested in Rupert's opinion as well.
Thanks for that. No, Michael, I completely agree with you. While we appreciate that Europe is certainly leading the agenda, and they have set out this comprehensive, you could say, approach to mobilizing the financial market to net zero within Europe, I do think that for there to be a global standardization, other markets will have to leverage the already fantastic work that's done in Europe. That's not to say that the EU taxonomy will be a plug and play in other markets, but what we've also heard from a previous panel today is certainly in mobilizing sustainable finance, taxonomies is certainly the best medium to do that. So I don't think that the US is certainly up to the maturity of what the European market is in integrating sustainable finance. And I don't believe that they are going to implement a replica EU taxonomy, different natural resources embedded within different regions, thereby they also have different taxonomies. But certainly there needs to be this commonality so that global investors can communicate and invest accordingly a common, you could say, strategy.
I'm going to jump in there as the American on the panel, I think.
You're not American, you live in London.
Well, yeah, I'm a citizen of the world, but I was trained as a U.S. securities lawyer. So, I mean, the U.S. has always approached things in a different way from Europe. I mean, there's completely different legal systems. One is a common law system that works off of principles. One is a civil law system that works off of regulation. And so I'm not sure I agree with some of the characterizations of advanced or not advanced, but the fundamental truth is, do you have words that everyone understands to mean the same thing? And that's what the word taxonomy means. Will the US implement the same glossary that the EU has? I have no crystal ball, but the US usually likes to do things in its own way. Do investors then have a way to compare things, which I think is the more important question? And does that come actually through the use of data as opposed to some kind of creation of a metric system? Or do people come to an agreement about what various words mean in a disclosure? I think that is a way forward. And I think, probably the EU was very, very happy that the administration changed in the US and that the US is back in play. And then they were very, very sad that the administration changed and the US was back in play, because now the US is at these tables and having these conversations with everyone, but with a slightly different approach on disclosure. And so I think October will be fascinating to see what comes out of those regulators. And I do think the SEC is open to innovation, but the fundamental underlying is companies know what's material. Companies need to be able to say to you, hand on heart, this is material and this is how I'm describing it. This is what I intend to do, and then be held to account for it. And I think it's that system of finding the right words right now, which is going to be a little chaotic, I would suggest, in the next few years as this language works itself through the system.
Yeah, and if I could maybe jump onto Anna Maria's point a little bit here too, certainly that is all true. I'd say another meaningful way in which the U.S. differs is that, there is aside from the federal government having intransigence over the past 4 years, but then not in the 4 years before that, and now we're doing a little bit better. The states in the United States have been making a lot of progress. So California, Massachusetts, New Jersey, where I'm from, are all making a ton of progress on decarbonization and creating their own standards, not green bond standards or anything like that, but certainly advancing decarbonization. And a lot of companies that are American are seizing opportunities because they economically make sense to do that. So, I certainly think that when the Biden administration laid out a Paris Agreement target that was twice as ambitious, even as the Obama administrations, they did it in part because a lot of progress is being made, even though the Trump administration was not exactly the one driving it forward, for lack of a better term there. So I do think that the U.S., as you know, is always more inclined to market-based solutions. In this case, it has bridged the gap a little bit, though obviously there's kind of a practical end to that, beyond which regulation will have to kick in.
And Anna Marie, what you described there is what we've been doing with the Common Ground taxonomy, but you tried in Europe, which are very conceptually different. Unfortunately, it's hard work, but it's kind of finding the words that match. Of course, the Chinese taxonomy is not called a taxonomy; it's called a green projects catalogue. And one thing that's become very clear from the US, if they ever do a set of green definitions, they're not going to have the letters TAX in the name of it, that's for sure. So there will be differences. The question is, will it be interoperable? That's the hard part. I note that today Walmart issued a $2 billion green bond, which is pretty cool. which is, I suppose, a sign of what Michael says of corporations beginning to act. And what I'm hearing, and a question to Agnes really, what I'm hearing from the BNP Paribas New York branch and other banks in New York, such as JP Morgan, is we've got people flooded with inquiries. Agnes, have I said that right? Is that what you're hearing? I mean, is there a buzz building?
Yeah, I would say it's more than a buzz. Actually, no, it's definitely more than a buzz. It's, I would say, when I started that job, it was, so maybe as a summary, effectively in my team, what we look at is specifically sustainable bonds. So really, we talk to all our clients issuing conventional bond and explain to them the benefits, but also how they are going to access the market, and then really find, the ESG demand for them in the market. And effectively, I would say, even if you go back, 3-4 years ago, you were in a lot of situations where actually, it was difficult discussions, especially a lot of the time it starts with the treasury team, very cynic views on the market and really not convinced at all. So it was more kind of, an approach from our side going into discussing what they could do in stable finance. We are very much in a reverse mode today, where it is actually very difficult to indeed kind of address all the requests and all the interrogations, inquiries, or actually people that say, look, actually I thought that through, this is going to happen next month, effectively. So definitely a big change in direction. Maybe what I would add, coming back to a few of the points that have been covered, and obviously we had already kind of the word greenwashing being dropped and data. I think what is really key, and what has been why we've kind of really been proponent of the taxonomy for BNP Paribas being in the tag and now in the platform, and why I find it really useful in my job, is that indeed, I do believe we do need a common language, because then we can disagree on it, show a gap versus that benchmark, but at least we know what we are talking about, which we've been missing in the market so far sometimes. And then we come to the point where we say, and being also at the excom of the principal with ICMA, of course there's the big angle, which is we need more transparency in the market, and if investors have the information, they will make the right decision. Going hand in hand with what I was saying, that we have actually a lot the vast majority of our clients that consider stable finance today, it means investors are flooded also with information. And so it's not only about providing data, it's providing the correct data in the correct format. And I think Anne-Marie, said, and comparable, because there is no point in having tons of data if nobody can filter through them relatively easily. So of course, Michael touched upon it, a lot of the providers are working on that. I do feel that every player in this market has a role to play. Some of the providers, at least in Europe, regulatory will have a big role being played here. But yes, to your question, on the issuer borrower side, stable finance is really our bond originators are at the moment saying there is no meeting where I don't discuss ESG, which, believe me, it's a big shift over the last few years. And on the investor side, it is the same. Even you would take, a fund that doesn't necessarily invest a lot in specific, green bonds or sustainability-linked bonds, they will still be asked as part of the RFP, what do you do in terms of ESG? What do you do at least in terms of screening? So that's very important.
So there's at least buzz going. This is a Western world, an OECD story so far. Namita, of course, 70% of the capex that we're going to invest to achieve, to develop a clean, green, resilient world is in emerging markets. So we've got to get that right. We need a lot of capital shift. All that money in negative interest rate German bunds and Japanese yen bonds has got to go to somewhere with yield, and that's more likely to be in Ghana or Indonesia or India or Pakistan going forward, subject to managing some of the geopolitical risk. Tell us what you see as the role of North investors in doing this. How important is that North-South transfer? Or in fact, could the emerging market do it domestic resources? What do you see going forward? You're muted, I'm sorry.
Yes. So I think there is a significant role that, if you look at the developed or the global North and the global South, I think there's a significant work or traction that needs to increase. So, I wanted to jump in also from a taxonomy perspective, where I'm saying that taking cues and support from the Europe, US, or other developments. In fact, the CBI taxonomania map is a great visualization of some of the international regulations or what's happening out there, which shows the intent and the support that policymakers, government, regulators, and also investors are putting in to channelize capital flows and meet the global climate ambitions. But what I agree with what was being said, while we're trying to build a common ground taxonomy, there is a requirement of some kind of harmonized, customized, localized kind of an approach, because there are differences in terms of geographic, economic, financial, social, and environmental. So how do you, balance of drawing from global best practices and account for those into the regional contextualization? I think that's a very important aspect. And as far as like Agnes said, that it's a glad thing that today investors, bankers, everybody's asking questions around ESG. I mean, this was not even happening a year back maybe, but this shows that there is movement, and those who have evolved, those growth investors who've evolved and who have like structures and frameworks, I think for the emerging markets, they need to reorient organizational strategies with those that they work with here. First, how do these emerging market investors look at commitments to green investments and not just theme-based financing? I am talking about as a core investment strategy. Then in terms of establishing well-rounded, effective controls to address and manage ESG or climate risks, I think those frameworks are emerging in India. I'm a part of the ministry's sustainable finance group, where we're building the disclosure framework, we're building the taxonomy for India, we're building resilience as well as regulation. And I think taking examples or taking what is working for other investors into consideration of into the emerging markets, I think that would be very important. I would place transparency and accountability giving it a very, very high value, given that the space of ESG is becoming very cluttered. We are seeing unclarity in terms of what is ESG. I mean, we've seen how ESG funds are also investing in fossil fuel companies. So what is ESG? And therefore that standardization, if brought out, would be good. Clear, candid stakeholder communication and disclosures to augment financial decision making and reveal the organization's broader narrative, culture, commitment, which in my opinion are very fundamental to return on investment drivers kind of a thing. And then innovation and capacity building. I think innovation is a key differentiator, how products are being structured, how they are being, how they're being deployed. I think these are very, very important aspects between market leaders and market laggards, or market followers, I would say, not laggards. So this is the kind of growth capital support, or this is the kind of support that is much required today to be able to move the needle. So these are my perspectives. Thank you.
Thank you, Namita. I've just realised we've only got 10 minutes to go. Really, this is a 2-hour conversation or longer. But in one of the sessions this afternoon, we had a bit of a discussion about challenges of inequality, the need and resilience, and the need to, while we're addressing mitigation, to also address equality, because if we don't, there's going to be blowback on mitigation agenda. If countries fall into populist modes, as a reaction to inequality that will set back for ages the mitigation agenda of those countries, let alone all sorts of other issues, let alone the need to have global cooperation, the need to make sure that we actually do what we did not do in the pandemic and share vaccinations around so we don't have people suffering in different parts of the world. If we don't address those sort of things, there's going to be other consequences, including nationalist populism and atomization, etc. Issues about defence, the amount of money. We're in a global arms race that apparently dwarfs the Cold War at the moment. And that money, which is going to stuff which is high polluting, could actually not just exploding, but aircraft carriers running on bunker fuel, could be put towards green energy. And then something else that came to mind is that an unintended consequence of climate change over the last 10 years, as the world has been heating, and emerging markets are becoming richer, we have seen an explosion of air conditioning, inefficient air conditioning, boxes stuck on the side of buildings. We have actually installed more air conditioning capacity in the world in the last 10 years than renewable energy capacity. Like, it's lunatic. So there's a lot to be done here in going forward, and it's not just a simple agenda of greening things. It's becoming complicated. I think becoming complicated is a sign of maturing, that we're now wrestling with the real issues, like what can we do in energy? Do hybrid cars qualify or not? Not under the European taxonomy, by the way. These are the frontier issues of our time now as we get used to the ambition. But for me, one of the key indicators of ambition is green finance flows. It's a key performance indicator. And of course, that's what we in the finance sector need to achieve or work on. Agnes, we're going to get to close to $2 trillion of green and sustainable bonds this year, by the looks of it. 80% growth globally in the market since last year. We've got to, however, get to much more than that. We need to be seeing a few trillion a year. I've been putting out a target of 1 trillion a year. We're running late, about 12 months so far, to make progress. So while we need to celebrate where we are now, I'm wondering, what's it going to take? What are your thoughts on today and in general about what it's going to take? What are we got to do? I suppose what the predictions are, the hope is to get to a much larger market than even the incredible market we achieved so far. And I'm just asking you all for a farewell comment to the audience, advice to the audience in a way, about this question. And Agnes, kick us off.
Yeah, it's a tough question for last question, but effectively, I think we always have to look at, how we say, quality and quantity. So first, I think on the numbers, it's doubling almost every year now. So, we are not, if that goes like this, we are going to get to 1 trillion a year very easily, at least. The key thing is, how do we make the jump to effectively really sizable? Because, it is, when you look at sustainable bond market, it is growing, obviously, in share versus the conventional bond, but still, of course, not to the extent that we would all like to see it. I would say, things like effectively, and that's why we talk about, comparability, standardization, having the same language, because obviously, we talk about greenwashing. This is on the mind of, borrowers and issuers as well. They really want, obviously, if they come to this market, it is to really put their best foot forward and really show to the market the good things they are doing. So the last thing they want is this to happen. So we really need to keep pushing on all those avenues. And the reason I was saying I was hopeful before is because I think we've done a lot of work on all of those in the last few months, I would say. One of the reasons why I think we will get to those big changes, because we have set those clear targets. And I was referring to the UN Net Zero Alliances. This is really key. At BNP Paribas, we were part of the first bank signing it for the Net Zero Banking Alliance, but you have that on the asset manager, asset owner side, insurance. So that's really key to shift the system. And I would say maybe the last word on your point. When I said earlier, in my mind, ESG is now unidirectional. We are really going in that way. I think the only thing in my mind that could derail it is the social aspect, because that will need, obviously this big concept of just transition, that will mean for a lot of workers, a lot of population, they will be affected by these changes. We'll have to operate. And how do we make sure that, everything is fine for them as well, and they can be embarked in the transition? So that's the one element I think we need to really address very quickly, as you say. Thank you very much.
Critical point, Agnes, and thank you again. Anna-Marie, Michael, Namita, Rupert. Anna-Marie.
Well, in that order. Look, I think I probably have 2 points in terms of expanding the market. One would be getting the market to a point where everyone is saying, why am I not doing a sustainable financing, right? Where that's the default. And then you have to explain why you're not able to do that, which is, would have been unthinkable, I think, when we all started doing this back in 2014. But I actually think that is coming. And I think the other one is transparency, because you are going to have this confusion for a while. And, you may still have it. Michael referred to IFRS and US GAAP. Those two still exist, but they have a nice little summary of differences. So everybody knows what people are saying when they say when they use those two different systems, right? And so I think having two systems is okay when it comes to a taxonomy type disclosure, and something else, as long as you know what you're saying and everyone knows what you mean. And so I think that transparency and a default towards why are you not doing a sustainable financing, and sustainable in its biggest terms, to Agnes's point, sustainable in creating a sustainable system that works.
Good point. A sustainable system. Michael, your parting comments.
Yeah, so I think this has been a riveting conversation, and one of the things I'm really eager to see, I've heard a lot of estimates about how large the sustainable debt market is going to be this year. We have estimates, obviously, that it's going to continue to grow substantially as well. I'd be more interested to see how much it broadens versus how large it actually gets. I think that we've seen a lot of interest in the sustainability linked market, for instance. We've seen a lot of interest, but maybe not execution in the transition finance market. For me, that's exciting. I know that there are risks associated with both of them. With transition finance, people are worried about greenwashing. With sustainability linked, people don't know if the targets are ambitious enough, or funds could leak to some purpose they hadn't anticipated. So you definitely get the concerns, but I think that those are tools that companies that are not conventionally green can actually use to contribute to this. And I think that if we are going to decarbonize to the level, kind of laid out within the Paris Agreement, it's really going to take an all hands on deck solution. And I do think that broadening the sustainable debt market is one way to help achieve that.
There we go, our marching orders. Namita.
You mentioned, Sean, about the unintended consequences of actions. And I think, conventionally, financiers use risk return as their basic to invest. And I'm talking about risk return impact. So there are investment strategies where investors are screening portfolio companies for financial performance and the impact that they have. And I think there are very few, and we need to go beyond the simple risk return kind of a formula and consider how financing can make an impact where it counts. So, I very much agree on the whole future about just transition. It's very required today to see that we don't wipe out communities or wipe out livelihoods of people towards the investments that we make or the choices that we make. So impact is going to be the biggest differentiator. And we've seen the race to zero needs many more financial institutions to run that race. We just have about 180 biggest investors who are there, but we need many more. And I think, one other, I was also looking at the green window, framing the sustainable future. And the question is, what happens at 2030? And we did the Paris Agreement, and then we had a 15-year kind of an agenda set out, different countries, regions, companies having different horizons. But what happens beyond net zero? And there, the important part is, how does the world look at going carbon negative So financing carbon negative technologies and so on and so forth would bring in uptake of, again, new kind of investments that are required to move the needle. So I think those are my last parting comments. It's time for us to think beyond net zero. Thank you.
Great point, Namita. Great point. Rupert, take us out with a final thought.
Thanks, Sean. I think to the comment about how do we expand the market, I want to refer to a comment that resonated with me earlier today from Samantha Sutcliffe, where she was helping issuers develop their green bond frameworks, and how this, by consequence, actually changed their internal culture of how they approach their operations. So mindful that the majority of the debt stock is within sovereigns, a way to, I would say, catalyze the green bond market would be supporting DMOs in framing their own green bond frameworks. I think if you work in ESG, you have to be an optimist, and I certainly am. And one of the things that I'm very much looking forward to is the outcomes that will come from COP26. And hopefully this will be a catalyst for governments to change the narratives from this is my NDC to this is actually how I'm going to fulfill my new NDC by 2030 and by mid-century. And a comment that John Morton had earlier today was that the markets have a herd community. And so what I hope to see is that when these new NDCs are issued by governments, that we're going to see sovereign debt pick up momentum and tapping into the green bond market in order to achieve these NDCs. I really think that this will move the needle in achieving a net zero world. And perhaps the last comment I'll say is a comment that really resonated with me from Neri, which was the cost of inaction within the green window will be much more costly than no action at all. Thanks very much, Sean.
Dead right, so true. The NDC one's interesting, Rupert, and one of the things that we will be coming to our partners with next year, discussions about how to work together to go to governments and support them on developing a credible transition plan, to use the title of our paper we published at last year's conference. And that's what we need everywhere. Targets are great, we need them, but we know there's a big gap between the targets, including the 2030 targets, and how they do it. And people have got to be pushed because they're caught up in arguments. Like in Europe, there's an argument. Well, we want gas, says Poland. But gas, says the IEA, is not consistent with the 2030 target. You can't do it. You can't make the sum square. How do we resolve these things? How can we use finance and how can we ensure we finance more aggressive solutions in places like Poland or Inner Mongolia in China or in Colorado? And one of the discussions in tomorrow's session on hydrogen will be how we can repurpose coal plants to use hydrogen. Well, this is what Thierry Leperc is working on in Spain at the moment as a transition strategy, which just hasn't been thought of by the countries that have got the coal so far. So there's a lot to be done in making this transition, but without the finance, it doesn't happen. And without the finance at the table to say it will invest, subject to sustainable returns, people don't even notice, don't even get up out of bed in the morning, don't even get excited about it. So we need you. We'll come back to you. Thank you so much for being part of the conversation today. I really appreciate you joining us, Rupert, Anna-Marie, Agnes, Michael, Namita, and I have to say a special thanks to JP Morgan and BNP Paribas and Ashurst, the sponsors of this conference. We've got a big day tomorrow. This is the final day, the last day of what has been a 5-day marathon conference. Are we crazy? I don't know. We're creating content. We're talking. We have Nathan Fabian in the morning, who's the chair of the European Platform on Sustainable Finance, working on taxonomy, and also the Chief Responsible Investment Officer of the Principles for Responsible Investment, kicking this off. We have a session on transition pathways with the Transition Pathways Initiative, the SBTI, Rocky Mountain Institute, how we're working together on this question going forward to support the investment community. We have Martin Spolk, who's really the architect of the European Action Plan on Sustainable Finance and DG FISMA, speaking. We have a session on green hydrogen as a turnkey for transition in so many industries, and how we think, well, our speakers are telling us, we're going to get to high volume, low cost green hydrogen unbelievably fast, which is basically to make you wonder, do we need gas after 2025? Interesting question to think about. We have a session with Nigel Topping, the UN's COP ambassador, a session on transitions in buildings, agriculture, transport, shipping. Chris Hahn from the Children's Investment Fund Foundation talking as an equity investor, the fact that we have to change going forward, and then the launch of our entities report, which is how we might be able to assess the claims of companies putting out sustainability linked bonds, doing sustainability linked loans, but in general, the corporate strategies and the corporate capex plans, assess them against understanding of what are adequate ambition for transition in different sectors. We want to bring whole entities into this market with their bonds, transition bonds, but also with the equity investments. Join us for that discussion to see what we're saying. And then, of course, we will end with a session like this, but tomorrow dominated by investors, CDPQ, Fidelity, and, of course, JP Morgan joining us with a particular take on what investors are thinking now about transitions. That's a tease. You've got to join me tomorrow afternoon. Thank you, everyone, for joining us today. Thank you, above all, for your interest, your willingness, and for our panel, and for everyone out there working in this industry, your enthusiasm and your energy to achieve a sustainable future for our children and sustainable returns, which is the secret of success for this transition. Thank you.